Welcome back, everyone, to another one-on-one with Jerry Hall. Today's conversation is with Mr. Robert Sherritt. He and his partner have built Cresco Fin. They are located and regulated in Switzerland. They provide, get this, literally risk-free savings accounts. You can deposit your fiat and earn 3% a year. Literally risk-free. How do they do that? You're going to have to stay tuned for this conversation. I think what Robert brings to the table will add a tremendous amount of value to those folks that are interested in how this space is growing up around us. I'll give you a hint. They use blockchain and they use smart contracts. They take real-world assets, put them on the blockchain, and insure them through Lloyd's of London. It's actually a really incredible little business model, one that I think you'll enjoy hearing about. Stay tuned because it's coming at you right now. So, Robert, God, it's great to have you on the show. How are you today?
Jerry, it's a pleasure to be here. Thanks. How are you?
Right on. I'm really well. You know, I found you when I was watching a Real Vision crypto interview between you and Raul. And this whole concept of building a financial system alongside the legacy system using blockchain technology, AI, machine learning, all these incredible things, to me is so fascinating because it represents, to me, an unmuddied capitalistic free market. And one of the points that came from your interview that really fascinated me, and I'd really like to dive into in deeper fashion, is through the process of taking a contract, putting it on blockchain, making it an asset, insuring it so there's like zero risk. You are starting the foundation of how all further or future financial products can be built on a solid foundation as opposed to a house of cards, kind of like what I see in the legacy world.
Well, that's absolutely right.
Where do you want to start with that?
Jerry, there's so much to get into, and you know, there's nothing sexier than talking about an interest rate yield curve. So I could do it all day with you, man.
Well, you know, let's start with this incredible business idea that you came up with, you and your partner, to take contracts, right, that were business relationships in the real three-dimensional world and digitize them as an asset, and then get one of the most reputable insurance entities on the planet to ensure their value.
Well, Jerry, it starts the way a lot of great ideas start. We were just pissed off and we were looking for a solution. So, you know, like here in Switzerland, interest rates went negative a couple of years ago and we went kind of nuts. I mean, nobody likes their bank anyway. And here we actually had to like pay to have your money in the bank. So, you know, rates have gone negative now in Japan, in Europe. The Bank of England has talked about putting rates negative, coming soon to the United States. I mean, it's just the last decade has been like a war on savers. And so, you know, my business partner and I, he's my oldest friend. And we're just like talking about just how annoying it is because, you know, you don't get a lot of value from banks. Sometimes you put up with it because, you know, whatever, you get an okay service in developed markets and you get a little bit of interest. But then when it goes negative, it forces you to think of an alternative. So we thought like, look, we're smart guys. We don't like banks. Let's build this for ourselves. I mean, we never actually thought about really building a business for other people. We just thought like, we'll build it for ourselves. And so that's what we did. So our idea was, how do you create something, if you were to build like a bank alternative for savers, what would you do? Like if you can kind of re-envisage how this really, you know, how this could work. And so, you know, and that's what led us to crypto, because we're not crypto native. I mean, we're not like, we're not programmers. I mean, we're quite technical, but I mean, eventually you realize that the moat that, traditional banks have built around themselves is just so difficult to like attack. You give up. And that's what you're designed for. Like, I mean, that's why your show about financial literacy is so great, because it causes people to ask some questions that a lot of people in legacy finance don't want them to ask, because it's kind of uncomfortable. So, my view of banks is they're kind of like a guild. I don't think that they're, capitalist or socialist. I just think they're vampires that live off of society, and they've created walls around their business model to protect them. So, it's only in the last few years that essentially new technology like, Bitcoin, Ethereum, we've had a relaxation of the regulations here in Switzerland, which allows a bank alternative. So it's only very recently that this has been possible.
Well, I'll tell you a lot of it. So obviously, you coming from we'll call it a finance background, because it is. I mean, geez, your first job out of college, I believe, was with a merchant bank, and you've been on various verticals within that industry. So you've got an understanding, right? And having been abroad in different countries, whether it be England or now in Switzerland and several others, you get kind of you get a more rounded view of how money works in the world, right? Just not in your little area. And for you to go, okay, globally, the safest way for me to secure my money, right? My energy units that are converted into a form of value in Switzerland is now gone, right? The safest thing you could do is invest in either Swiss bonds, US Treasury bills, or put your money in a savings account. Those are kind of the steel nuts of, the pristine places to secure your value.
Well, it's worse in Switzerland. It's worse in Switzerland. It's worse because actually Swiss bonds are negative, and like, interest on the bank is also negative. So actually, that's why like shows like yours are so great, because you're not afraid to ask, like, you're not afraid to ask questions, and that's what's
right.
important in the world, because many people, particularly in finance, they hide behind jargon. They try to make you feel silly for asking these questions. But look, if it's negative in the bank and short-term bonds are negative, what's the better alternative? Well, you could ask like a child, and they would say, well, don't put your money in that. Just hold your cash separately.
In your wallet or in your
exactly under your bed or whatever, right? So in Switzerland, there's actually a couple of funny stories, and I mean, Raoul on Real Vision has mentioned as well, because he's heard, I guess. But some Swiss asset managers who have like an insane amount of money in the bank, they actually went to their bank and said, you know what? We've got an alternative. It's like a warehouse, and it's protected and whatever, and we want to take out like our whatever 100 million Swiss francs, and we'll just store it separately, so you won't lose money about it. And the bank said, like, you obviously haven't read your banking contract very well, but you can't do that. I mean, actually, it's not actually your money in the bank. When you put your money in the bank, legally it becomes the property of the bank, and you become an unsecured creditor. And what they give you is an IOU, which is called a bank deposit. But it's not, many people think, like, totally falsely, that like your money going into a bank is something like Ocean's 11, where it goes into some back room and there's this huge vault and some guy closes some steel. It's just not true. It's just entries in a ledger. It just happens to be the bank's ledger, and they're not going to let you take it out. So, it's really cool you ask these kind of questions.
Well, I think it's important, because here we are. Okay, I'm just going to use you as case in point, right? Middle class Canadian kid, right? Good life, had a good childhood, pretty well adjusted, grew up handsome, so I'm assuming you were popular. you head off out of high school, right? The public education system, and you want to go off to university. And you go off to university, and in your case, your graduate degree was in economics, right? So you go to school, you get your economics degree. And then immediately after your 4-year undergrad, you went for graduate school, correct?
Mm-hmm. Yeah,
right.
just to clarify, my undergrad was a little bit more general, and I might have spent too much time kind of enjoying myself in the fraternity house. But
Well,
I then went, and did a Master's of Science degree in finance at London Business School. So I should know about finance. But
well, here's the point: undergrad, master's degree goes into the real world, into the workforce. And you did not know about fractional reserve banking.
Yeah.
Tell me the story of how this young, bright, educated young man gets a job in finance and does not, in the light bulb that went off when you realized things weren't the way you thought they were.
Well, it's probably a computer error that I got hired anyway in a bank. But after my master's degree, my master's degree thesis was on valuing companies in countries that didn't have a developed capital market. You don't have a long history of securities prices, so you can't use some of the standard valuation models, to value assets in those jurisdictions. Like in the UK and the US, you've got you've got stock and bond data dating back 100 years. So I found myself in my mid-20s in Moscow, in Russia, working for a large global, bank, and we were making a loan to a Russian company. And say the loan had a value of 100. Well, we had a value of 5 in the subsidiary in Russia. So, I just, I'm a curious young guy, and I'm I'm happy to just ask lots of questions. And I kept asking how do we make this loan? Does it come from headquarters in London? Does it go through the Russian central bank? And finally the treasurer at this global bank pulled me aside and said, listen, kid, here's how it works. I enter the numbers in the loan account that we're going to give to this Russian company. And then I create a deposit account, and I type in the deposit amount in that, and in their deposit account. And that's then the money that they can access. And so we give them a deposit account of 100, loan accounts of 100. Obviously, they're going to pay interest on that over 5 or 10 years, and that's how it works. And it's just shocking, because typically what you learn at university is that banking matches excess capital to required uses in the real economy. It takes money from savers. It also taps funding markets, like the bond market. You can access the central bank, but nowhere does it say I just tap the entry into this digital ledger, and voila, that's it. There's their money. It's a bit shocking. I mean, I ended up just kind of wandering around a gray day in Moscow, and sitting on a park bench a long way from home, and just kind of asking myself, what really is money?
That is the $1 million question, right? And it continues, the answer continues to evolve. For me, I'll tell you, one of the things that, there's this, these pillars that define money, right? It's a measure of account. It's a store of value. It's fungible, it's divisible, dun, 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 dun. Well, we start looking at these things and we start to see, whoa, wait a second. Even some of the absolute pillars of money are starting to go to the wayside. Money is no longer a store of value. Things that we consider money, let's call it fiat currency. Fiat currency is no longer a store of value, right?
That's so true. It's so true. And so
inflation is the counter argument to that. Somebody says, your dollars are a store of value. Well, actually, they're not, unless you factor in this dollar is storing 90 cents for me next year.
Yeah, exactly.
You know what I mean? Which is,
no, it's so true. And It's so true, and you know, Jeff Booth captures that so well in his book, The Price of Tomorrow. I think you've talked to him, right? And like,
Yeah.
but you know, for me, it's really simple. Like, you know, inflation and deflation are not necessarily good or bad. It's, you really have to look at it from the perspective of like who it benefits. And so, inflation benefits you if you're essentially a borrower. So if you're somebody who can like issue bonds, or you can create you know, money, and you're paying it back essentially by borrowing, then inflation's good for you, because the money that you have to pay back at 100 in, you know, 5 years time doesn't have the same purchasing power as 100 today, right? It has less. So actually you're paying it back with the same, you know, value of 100, but the purchasing power is like 95. And so, you know, what's really interesting is like you have to look at who are the biggest borrowers in any economy. And then you see that the biggest borrowers are government and the banks. And then you say, well, who can create money? Because that's inflation. Who can print money? Well, the government can and banks can. So for me, that's inflation. And deflation is just, deflation is simple. It's just the reverse. Like, you know, if you're a borrower, deflation's terrible. If you're a saver, deflation's amazing, right? That's what you want. And so, you know, the reason why we have like a target annualized rate of inflation of 2% or whatever every year is basically that's a theft rate, right? That's how much of your purchasing power is targeted to be stolen every year by the government. So that's how you understand. For me, that's a simple way of understanding inflation and deflation. And
right, no, it's perfect. Which I think is a great segue into the concept that you and your partner had about, you know, creating this kind of all world way to produce a guaranteed yield, right? Which I think in the initial days of bonds were what bonds were all about. I think that was the intention. I could be wrong. I wasn't there in 1610 when they were created, but when I look back and I see how they were utilized, it appeared that they were the safest collateral. Because not everybody lives in the same spot of the risk curve, right? I might be a little further out on the risk curve than my grandmother, and rightfully so. Our circumstances are different, our goals are different. The world has gone away. There are no safe places anymore. Well,
yeah, that's right.
I'd really like to dive into that, because you're bringing that back.
Well, I think what people are doing is people are opting out of the system, and I think that's the crypto movement. I think people have realized, whether they've realized it is exactly as I have, that banks are like guilds, and they essentially, you know, technology has attacked a lot of industries for decades, and banks really haven't been touched. I mean, you have some fintechs who kind of nibble around the edges, but they operate in the same old technology stack, which is fractional reserve banking, which is essentially, it's an inverted triangle. It's like an upside down house of cards. And I think what people in the crypto industry have looked at, and they said, I'm just sick of that, whether it's banks, central banks, centralized control. I mean, that's what crypto is really all about. And we had the same idea. We were simply like the same philosophical concept. We're just like pissed off. We didn't like the system. You don't like the game, and so you want to play a different game, right? So our idea was we cut out the bank.
There's a huge difference between, quote unquote, the crypto space and what you're doing, and that difference is counterparty risk. Well, risk in general, right? This concept that you have of taking a contract, digitizing it to represent an asset, and then having it insured eliminates risk.
Yeah, you've got it absolutely right. I meant philosophically, we've got the same. Philosophically,
there's no element in crypto that's anything like that.
No, that's perhaps true. We started off by doing it in the real world, even though we use a blockchain tech stack. but philosophically, we're just like the people in crypto, like we're, you know, which
no,
we are. I mean,
but there, again, back to I'm an investor, dollars are dollars, and zero risk has a value. It may not be valuable to everybody because zero risk does not pay 12, 14, 15, 18, 20%, 5,000%.
yeah.
But you figured out a way to get zero risk to yield 3%.
Yeah,
Nobody in crypto is doing that with zero risk.
Well, let me tell you how we did it. But the background is essentially, it's, you know, the only way to compete with banks' psychological advantage of being safe is to have things insured. Right. I mean, it was in 1994 that Bill Gates said banks are dinosaurs. And like since 94, the banking industry hasn't suffered very much from the technology attack. I mean, not many people bank with Google, Apple, whatever. And the reason we think is psychological. It's because of insurance. So what we did is we thought finance is all about risk and return. I mean, financial literacy in terms of modern finance theory all starts with Harry Markowitz's PhD thesis at the University of Chicago in the 1950s, where he said, everything boils down to risk and return. And that's what modern finance theory is based on. So we thought that we'll make the risk insured. So that'll be incredibly safe. We're going to cut out the bank and we're going to see what we can squeeze out of that, like what kind of return we can get. And so we do that by doing a little bit what banks do. We don't like banks very much. So we don't actually do lending because lending is a promise to repay. And that's not crypto, right? What we really wanted is we wanted to hold an asset and control it ourselves. So every business relationship in the world starts with a contract between a seller and a buyer. And so that's what we do. We start with like that contract and we turn it into essentially a smart contract. We have a concept that our CTO has developed. It's really cool. It's called the proof of delivery. And it just essentially hashes to chain the proof that what the seller has delivered to the buyer is delivered. And it's on this giant open record book called the blockchain. And so the seller and the buyer agree that if it's written to chain, that's the truth. Our software produces the invoice because in anything to do with invoices or contracts or accounts receivable, it's a rotten industry. It's full of fraud. It's like, you know, but if you do it in a crypto way with you know, essentially based on smart contracts, and then you control the output, you can't fake it, right? So,
well, we end up with, as long as there's a non-biased Oracle solution, because a blockchain by itself doesn't have any value whatsoever unless it's getting good inputs from the outside world and bringing them to
that's right. That's right, for sure. And you need agreement. So we have agreement. The seller and the buyer agree that written to chain is the truth. And then what we need, and then we get it insured. And then so we've convinced the Lloyd's insurance market, which is famous for like, you know, insuring ships and things like that and being old fashioned, but they're not. I mean, they're actually really amazing at looking at, you know, things that are kind of unique. Like, you know, they have a different perspective on things. So they did a deep
insure Keith Richards' hands.
Yeah, that's right. So if you want to,
or Johnny Depp's career as an actor or something.
Yeah,
I mean, they've insured a bunch of what we would call non-traditional value.
That's right, Jerry. If you want to insure anything about like your YouTube show or whatever, you want to get insurance, you go right to Lloyd's. It's unique stuff that they insure. So you can't get like a plain vanilla insurance contract for something like this. And so we hired a head of insurance and risk management. This great British guy, Simon, spent his career in the Lloyd's market. And so we have like a customized insurance policy that takes into account like the blockchain, takes into account how we transform ordinary like real world invoices into smart contracts. And so we get the end result is you can look into all the tech details, and it's pretty interesting if you want to do that. but for normal people, you can just say it's insured. Like I do this when now we've opened up to, you know, outside parties, because my partner and I tested it for like a long time with our own money. Thought if like if we lose money, it's only us, it's only our money, nobody else gets hurt, and it worked. And then we decided to open up to other people, like we do family offices here in Switzerland. And I started off by going into all the cool details. I thought of like blockchain and how it all works. And, you know, my partner just was like, look, stop it. Like, it's 3%, it's insured. How much do you want? Same as a bank, but better. So that's what we've got. And now we're putting that like really on chain. So we're developing an offer where we hope anybody anywhere in the world will be able to send in money essentially to us as a regulated Swiss company and have like an insured bank account on chain and we're going to do it in US dollar stable coins. And the other thing that we're doing that we're super excited about is we're building a money market on Aave, and Stani from Aave, who's the founder, is like advising us. He's on our board of advisors. Sorry?
Spell Aave for me.
Aave.
Aave.
It means ghost in
Gotcha.
Finnish, as everybody probably knows.
I was looking for that from your last. Your business is incredible. Let's act like we're talking to sixth graders, because that's sometimes
Cool.
That's how I learn, right?
Me too.
So I am a sixth grader, and I happen to have $10 million in savings, right? I didn't tell you I'm part of the Rothschild family, and I've got this big old pig. And I don't want to mess around with speculatory investments. I don't want to have attack vectors getting me from all over the place. I just want to be a kid. I don't want to worry about risk. I find Cresco, Finn, and
I have to pay you for this. Sure.
And I'm thinking 3%. Well, I can't get 3% anywhere else risk-free. So I'm willing to, here's my 10 million US dollars. I get them converted somewhere in the USA into stable coins or something, and I send them to you. You're going to give me 3% a year. Okay, that's great. That's a lot of candy money and comic books and stuff for a sixth grader. How is that 3% created? Where does the 3% that you're going to give me created? Because it's not like you have a lot of other vehicles. You have to go somewhere else and take that money and put that money to work. Walk me through that process, because that part was unclear to me in the Raul interview.
Well, I think what you would say to, like, you know, a kid who's like, you know, considering essentially investments in a very simple way is that you have to put a framework to it, and it's the same regardless of what age you're at. It's risk and return. So, you know, you need to consider, like, there's some things out there that advertise you can make 10%, 20%, etc. And you have to consider what is the risk for that. And the risk technically is just, what are the chances that things go wrong, right? I mean, in technical terms, we talk about it as the variance in the denominator of essentially of the mean of the cash flows that's in the numerator. And it's just simply saying, you know, you expect to get a certain outcome, but what are chances that it varies around that outcome? And so what we were trying to do, what my partner and I were trying to do, was just to make like something equivalent to having your money in the bank, but not have a bank. And we thought, well, what happens if we cut out the bank? And if you look at it, like my partner in one of the Real Vision interviews, he had like pulled out like an annual report for his own bank, and he had started looking at like the cost items in the bank that you might cut out, right? Like headquarters was like more than £500 million for his bank in the UK, and like there's something called regulatory and compliance, which was like, you know, all their legal costs, and like they have obviously bricks and mortars, lots of employees. It's very different if you're a technology company. And so that's why we're built on essentially a blockchain tech stack. And what we do to make money in the real world is actually very simple. So like I said, there's a relationship between a seller and a buyer. There's a contract. We essentially take that contract and we buy the output from that contract. I mean, so the seller sells something to the buyer. We make sure that that is agreed. The seller and the buyer both agreed that whatever good or service that the seller is delivering has actually been delivered. And then you're waiting for the typical terms of payment. So that's like, say 30 days. So, you know, you could say to the kid, like, look, you're selling something to somebody, like, I don't know, at a lemonade stand. So you sell lemonade to somebody, you know, and that person's going to pay you in a month, because those are the typical terms in the business world. And then you have to say, a month later, what you don't want is, you don't want somebody to dispute that they actually got delivered the lemonade. And so what our mechanism does is it does what, you know, blockchains are great for. It records to chain in an open, transparent way that both of those parties can see, that proves that the lemonade was delivered. And so lemonade delivered, and then you're just waiting 30 days later for whoever the buyer is to pay for what he got delivered. And so in our case, what we do is that we cut out disputes by recording it to the chain. We cut out fraud by producing the invoice out of that software, out of that chain, essentially ourselves. So nobody else produces it, we produce it. And then if the buyer doesn't pay, Lloyd's pays, the insurance company pays. And so you'd be shocked, but like, you cut out the fat from the bank, and even after paying insurance and like giving a margin to us, because we need to eat, I need to keep the lights on, I have like, you know, a small team, but we can then pay essentially the depositor 3%, and it's insured. It's totally insured.
So is another way to look at this, because I'm really trying to understand it, is as a depositor, do I also become a buyer? Am I buying contracts that are going to produce X?
Yeah, you are. With us, that's with us you are. And that's where it's really different than a bank, because we have three parts to our model. One is matched funding. The other is the use of the blockchain. And the third is insurance. So that's great. You ask absolutely the right questions, because
in the scenario, because for me, the buyer or depositor, there is no risk because of the Lloyd's insurance, because of the insurance. Even if the guy that I have a contract with to produce that lemonade in 30 days hasn't paid for the lemonade that was produced, Lloyd's is going to cover it. Okay, risk-free to me.
Exactly.
Now, here's the part of the equation I didn't understand. There was the guy that needed to borrow something to get the lemonade that he's going to repay.
Mm-hmm.
I heard you say in the interview you don't really want to lend.
That's right. So what we essentially do is we finance the guy. So we finance essentially the kid, I mean, who's selling the lemonade. So the kid sells, you know, in this scenario, we haven't rehearsed this, so we're making this up, but like the kid who's selling the lemonade, he sells the lemonade. That guy's going to pay him like whatever, $1 in like 30 days. And he thinks, well, you know what? I'd rather have some money today. And so what we do, what Cresco does is so he has an invoice, right? Like he has a bill that's going to be paid in 30 days by the buyer.
Cresco, his lemonade contract.
That's right. We might have invented something here, but like, yeah, we essentially, what we do is we turn to the guy who's like sold something, lemonade in this case, and we say, look, rather than waiting for 30 days and getting paid at 100, we'll buy it from you today at 95. So you get your money, and you get money in your pocket today at 95. You're totally de-risked. You don't worry about the buyer. We actually don't worry about the buyer either, because it's insured. But we buy that contract at 95, and then we get insurance on it. So my costs are essentially buying it at 95 and paying the insurance. But you know, you put your finger, Jerry, on something that's really interesting is that it's typical crypto. So it's non-custodial, and you don't rely on us. So in the real world, what does that mean? It means that your money goes into a fiduciary bank account, which is then used to purchase an asset. And so you have essentially title to an invoice for the lemonade that's going to be paid in 30 days. And you also are named as the loss payees technically on the insurance contract. And so, but what it works out in normal people terms is you have a savings account with an insured rate of interest at 3%. And we've done it in the real world. We've used smart contracts in the real world on the blockchain stack, right? We can offer it to traditional institutions like we're doing now in we offer it in dollars, euros, and Swiss francs. And then we're going to put the same thing on the Aave money market. And we're going to offer it to people who can buy it in stable coins in the future. So that's it.
Well, I mean, I'll tell you what I'm seeing, right? I'm seeing potential applications here for anything in supply chain, right? Yeah. From the manufacturer of widget A all the way through every input that made the widget. It's staggering. And if I don't want to be involved in any of that, I can just produce some capital and get a guaranteed rate of return.
Yeah, that's absolutely right. It's funny, we're talking on the day essentially that ETH2 launched, and what we're doing is enabled by public blockchains. And so I think in the future, the old world where you had two different black box SQL databases that held proprietary data, like in the supply chain, for example, that supply chains, banking, many things rely on information asymmetries. That's why savers get disadvantaged, or it's why the coffee bean producers in South America are disadvantaged by the centralized entities that sit in the middle of supply chains. And Ethereum is going to change that completely. I mean, it's really
blockchain is going to change that.
Blockchain is going to change it. I mean, I like Ethereum because it's like it's like, for me, it's the smart contract. It's like it's like Nick Szabo's idea of this smart contract, which is best explained as like a vending machine. Like you put in a quarter, you get out like whatever, your bottle of Coke. I mean, there's no intermediary. It just runs automatically.
I hold some Ethereum, but I will tell you, in the world of cryptocurrencies, like for instance, I'll just give you the quick wrap down of my portfolio. XRP is my heaviest weighting. Cardano, which is another smart contract POS platform, is my second heaviest weighting, then Bitcoin, then Ethereum, and then a supply chain management called VeChain.
Ah, cool. Okay, that's great. You know what? I'm really ignorant of crypto. Like my philosophy in life is that banks suck, and I'm going to do whatever I can to try and replace the banking industry. I mean, I first got into Bitcoin probably because I actually, the answer to my question when I was sitting on that park bench as a young guy trying to figure life out, or at least money out, was Bitcoin. Then I discovered Bitcoin, and I was like, oh, I have the answer to my question. This is money. I mean,
Bitcoin
but I'm really ignorant. Like I'm really ignorant. I'm sorry, of XRP and like Cardano. I just don't know them very well.
Ethereum is wonderful. However, I'm also a guy that had to live in the real world, right? I'm not an academic. And I can tell you that if this tool does the same job at this tool with all the same qualities, but does it for 50% lower, I'm most likely going to use this tool. Now, Bitcoin and Ethereum are wonderful for what they've ushered in. However, the cost to be a part of that ecosystem, there's new, better tech that eliminates those or reduces it by orders of magnitude. Therefore, thank you for bringing this concept to the world. But it's just like, I mean, you have a cell phone, I'm assuming, right?
Yeah.
By any chance, is it a Motorola Razr S?
Yes, it is.
No, it is not.
No,
Liar.
Yeah. Come on, it's an Apple. You know it is. You can see it.
Iterations of this technology are going to happen. And so don't be surprised if you find yourself with your tech team at some time looking at migration to a better, more efficient blockchain.
Yeah, look, I mean,
Get
the whole
married.
blockchain space, I've never seen anything so tribal, and I like, I'm really intimidated by it. I mean, I just stick to my view. I'm pretty naive. I mean, like, I just think banks suck, and I'm looking for
They do.
my view. Our vision is to replace banking with code, and
Yes.
I'm going to do that, or I'm going to die trying. I mean, so I'm looking for whatever solution I can get to do that. So look, we operate in fiat currency as well, because why not? Like we have we have like users in the, in the real world, the traditional world, who are like, my God, like, 1% in Swiss francs, 1.5 in euros, 3 in dollars. This is much higher than I can get in a bank. And I'll take a lot of that. And like, what I'm really excited about blockchain is it's moving beyond just the tech discussion. Like it's like, I know it's a very tech centric industry, but I think to explain it to normal people, you need to talk in terms of the benefits. And for finance, that is like, what can I get and what's the risk? And so when you say 3%, insured, people are like, I'll take as much of that as you can give me. And then they say, like you do, well, how do you generate those returns? And I have to say, well, it's crypto and whatever. And like a year ago, people are like, some people were like, oh my God, crypto, I'm not doing that. You're financing something on the, dark net or something like that. And this is the kind of thing. It's like, it reminds me of some story about like Jeff Bezos when he was raising money for Amazon, in the early days. And the most common question he got is, what is the internet? And so that is a question that you would get maybe a year ago. It's really changed. It's really changed. You know what? For me, it changed this spring when Paul Tudor Jones announced that he had like Bitcoin in his fund as a hedge. That is what's changed. Real Vision has done an unbelievable job of educating people for like, years on like how great this is. There's been people, like you and elsewhere in the community that are doing an incredible job of education. And that's what's needed for any new technology. But it's coming. Like in institutions, it's coming, Jerry, because of the war on savers. Like I said, it's been a decade of this war on savers to try and replenish essentially the bank and central bank balances after the great financial crisis. And like, people are sick of it. People are looking for alternatives, whether you're a little guy who's into crypto, or whether you're an institution who also doesn't want to have their money in the bank. So I really think 2021 is going to be a year of like insane adoption amongst institutions.
Well, I think that's true. And I will tell you from just my opinion, right? Observationally, you're positioning yourself to be like a staple in every investor's portfolio. Like I may not, I'm not afraid to live a little bit out there on the risk curve, as evidenced by the story I've told you of what I've invested in. But I can absolutely see a time where I have a net worth that is going to force me to have certain amount of positions in a zero risk type of situation. And why would I take a bond that might only give me 25 basis points over 5 years, 10 years, or I can talk to my buddy Robert and get 3% a year. You know what I mean?
Well,
that doesn't
you gotta call me for sure. But it's
but
it's a boring product.
It's a boring.
It's boring. It's designed to be boring. I obviously am like really crazy interesting person, but like this is designed to be like boring, low risk. What we want to do is we're unbundling that part of banking, which is basically core deposit banking. I mean, I really think it's the first tech challenger to core deposit banking. And it works because of crypto. It works because of the regulation here in Switzerland, and it works because it's insured. But this is all we want to do. I don't want to do anything else that a bank does. I want to be this one, as they say, money Lego that is like a really safe savings account. Everybody has money in the bank. Like it's not an investment decision. It's like, and the market's enormous. It's like $60 trillion market. That's what we're trying to do.
Well, I can tell you this. If you're going to disintermediate banks, right? You single-handedly, your company is the death nail for banks. You're going to need really good on and off ramps to your customer bases. So whether that looks like, super badass apps on your phone or whatever, unfortunately, right now, you need banks because that's the only way your customers can get you the value.
Oh yeah, it's true.
So the very thing you're going to slay is the very thing you need to grow. It's kind of a weird paradox you're in and tightrope that you have to walk in a way, right?
Yeah, look, the finance industry is a real challenge, and so we try to operate in both sides. Maybe there's some way that we have like a partnership together with the bank in the future. I don't know, but we're designed for the traditional space as well. We're the first essentially crypto company that has an ISIN number. ISIN numbers are like, it's the standard thing in traditional finance. You might know, like if you're an asset manager, money manager, family office, and you want to buy a financial product like, shares in Apple or whatever, 3-year Japanese bonds, they all have an identifier, which is called an ISIN number. So we've got ISIN numbers for our products. It's quoted on the Bloomberg, which is the standard in traditional finance. So you have to work with both. And that's why we're really, the one thing that excites me the most is building a money market on Aave. Like Aave is this really incredible money market, open permissionless protocol in DeFi. And it's like what we're trying to do, we've made an official proposal in their governance forum, which is essentially to put our regulated, insured collateral on this Aave money market. So it will bring, regulated, safe, secure assets to DeFi. And I know some people in DeFi won't like it because it's regulated. It just is like, so, but there's other alternatives, lots of alternatives in DeFi to this. But what this does is it kind of provides like this, like we talked about in the beginning for the rate curve, it's risk-free, or it's as close to risk-free as you're going to get in crypto, because there's no sovereign issuers obviously in crypto. So we thought, it's insured. I know it's boring, but it's like, it's a place to park your money while you're not like yield farming, or whether you're not doing something else, or it's a way that like people can. We really hope to lead adoption in crypto. So regardless of where you are in the world, you can deposit like, USDC into the money market in Aave and make 3% insured, permissionless, regardless. Well, not permissionless because, you have to go through the regulatory process, but it's like, it's non-custodial, and you can do it from anywhere. So that's what we're trying to develop. And regulation, I have mixed feelings about it because I'm kind of a libertarian. I wish it didn't exist, but and mainly it's used to protect the banking industry. But at the same time, there are some unpleasant people in the world, and money laundering, for bad stuff does happen. So fortunately, the Swiss regulations for KYC are very simple. So this is the idea. This is the genesis behind that like yield curve idea in crypto.
I think it's brilliant. I'm very much looking forward at seeing the progress that you make. I hope that I can have you back on in the future to talk about new developments and things like market saturation and, how maybe even in your view, 3% to some people is sexy. And I think that's really important because, like I said, I think this new financial system that's being built in parallel with the legacy system needs to be able to offer, right, to the masses. Well, the masses at large are not big risk takers. Entrepreneurs are big risk takers, right? Gamblers are big risk takers. Conservative, good old folks that just don't want to see their dollar today turn into 90 cents next year, they're looking for something that they can feel good about. They can set it and forget it.
Yeah. There used to be a time, maybe you and I are probably old enough to remember a time where actually you could put some money in the bank and you'd get some interest on it, right? I mean, I had a nice chat the other day with Jessica Walker, and she was saying growing up in England or Wales, she could remember like her grandmother would give her like, you know, 500 pounds and it would actually turn into something. You get a bit of interest on it. And like, it's really tough for the millennial generation today. Like you get nothing on your savings, bonds earn nothing. And because the yield curve is artificially forced down, riskier assets have increased in price. So it's really a raw deal that millennials have got, because you make your money, fine, but then
take risk, forced.
You're forced to. Yeah, you know, for me, for example, when rates went negative here in Switzerland, my banker's suggestion was, well, we have this in-house fund where you can put your money into it, and like, you know, and it's like guaranteed you're going to lose money in this money market fund, but it's not quite as bad as what you're going to lose in the bank. So that was one option. The other option is real estate. That gives you a yield, but it's illiquid, right? And then the third option, which they really pushed, was, well, why don't you buy shares? So, you know, it really starts, I mean, I'm really passionate with this idea because, you know, it means something to people. I mean, you work hard for your money. You know, you should be able to make your money work hard for you, not hard for the bank. So that's really what we're trying to do.
Well, I'm excited. I'm so absolutely honored that you took this time with me today. And like I said, I hope that you'd be open to coming back and, you know, talking about the progress, talking about things, new developments, you know. It's always, to me, extremely humbling to get to interact with people that have a far deeper wealth of knowledge than I do about any particular topic that we're discussing. And so I'm grateful for your time. Thank you, Robert, so very much. You've been an incredible guest.
Oh, please, it's my pleasure, Jerry, to be here. It's really amazing what you're doing with financial literacy. I think it's really, you need to encourage people in general in life to ask more questions and not to feel like, you know, not to feel intimidated, because that's what many industries, in particular the banking industry, makes you feel. You feel intimidated to ask about things. So it's really an amazing show that you've got. I'm really I'm really touched that you wanted me to be part of it.
Well, right on. Thank you. So folks, from Switzerland and from Costa Rica to wherever you are on the planet, thanks for tuning in. And until next time, Pura Vida.